What was your takeaway from the lens of an equity strategist?
I think the difficulty now is that you've got two separate economies which are becoming more and more divergent. You've got an asset economy, which is housing and equity markets and credit, which are going into sort of the very overheated stages globally. And you've got the real economy, which in part is still trying to mean revert to where we were pre-pandemic. And again, unemployment rates are still not necessarily suggesting that the Fed has got that room to tighten that dramatically. So the question for me really is whether we're still seeing earnings growth and so forth, but whether the costs of the asset markets in terms of changes in policy are going to make life much more difficult further down the road for the Fed, i.e. that they start to tighten policy and the asset markets react negatively. And that, to some extent, is the big risk for the Fed from now on, because we've seen really any time when the Federal Reserve has ever lifted rates back in 2000, 2007, 2008, you had the tech bubble burst and then the housing bubble burst. And it wasn't anything to do with the real economy that was actually the trouble for the Federal Reserve. It was the asset markets. And I suspect that that's going to be the problem for the Federal Reserve sometime in 2023. The asset markets will be very, very rich and hypersensitive to any changes in duration.
You've been talking about this U.S. rally in stocks. I mean, it's just record after record. I think it's, what, 50 or 60 records that we've seen in the past 160 sessions or so. I mean, you lose count. Is there anything besides just liquidity that's supporting this market right now, or do you think there's actually some easy catalyst that could actually trigger some kind of pullback now?
Well, the reality is that it is supported by earnings growth, and you can't get away from the fact that corporate pricing power is some of the best since we've seen since the 1970s. So coming out of this recession, companies were able to raise prices very, very quickly. The difficulty is it's been accompanied by insatiable risk appetite in certain areas, and we highlighted the fact that call option buying in the United States by volume is at record highs. You've had certainly huge flows into areas like cryptocurrencies, very, very strong underlying demand in companies with very low share prices, which tends to reflect very strong retail involvement. So the difficulty is that at some point the earnings numbers just can't get any better. We've had the best ever earnings season. And I think the difficulty for me is when companies did miss in the last reporting round, they dropped sharply. So it may not be the fact that the economy does poorly, but the company margins, companies just can't pass on the costs. And I do say that if you bought anything from overseas, the freighting costs are up nearly 5 or 6-fold. That has to come back and hit the consumer at some time, and the companies will have to essentially absorb that cost themselves.
Again, though, you know, they are paying that much more for shipping things. As you know, we did have Kamala Harris say, "Buy your Christmas presents now." That's one of those things. But right, some of that was obviated by the fact that there is zero money. The punch bowl is there. These asset prices go up in places where you don't need them. That's the problem. That's what we saw in 2008 and after the GFC, didn't we? Very, very quickly.
I think the difficulty will be is that you go from very, very negative real rates to modestly negative real rates, and you either have credit spreads widening very quickly or the dollar strengthening, and that in itself tightens financial conditions at the margin very, very rapidly.
You know, we get all these regulations coming in, and some of them contradict one another, but there's one thing which seems to be the overall narrative, and that's an ideological back to basics. Is that something that you look at?
So the way I'm looking at it at the moment is that essentially companies, in terms of the margins that they're making in China, are going to find that that comes under management by the Chinese authorities. So it's not so much excessive growth at the top line, i.e. how much you're growing the business, it's whether your margins are way too high in relative to the SOEs or competition. And the way I would say to you is that the authorities are going to use fines or visible taxes and indeed...
Or you simply give some of that money to charity beforehand.
Indeed. And that the difference between net margins between SOEs and the private sector are going to narrow over time. So I think the issues that the equity analysts and strategists and the fund managers have had is that they've just looked at the threat at the top line, i.e. how much business that these companies can generate. Well, I think that's to some extent going to be regulated in a much more normal fashion, like an antitrust, as we would see in the West. But on the bottom line, it's going to be latent and hidden taxes that are going to actually crimp the margins of the private sector. And to some extent, we've seen this in the West before. If you remember, after the GFC, all the banks were given fines for stuff that they had done pre the GFC as ways of recuperating some of the money that was injected into the financial system. I think this is pretty much the same thing that's going to happen to the private sector. You're not going to be able to make excessive margins in the future.
You have a new report saying what goes on in China does not stay in China. Not talking more about the crackdown, but more so about a slowdown that we're seeing in China as well. How do you think that's going to filter through for EM, Asia, the like?
Yeah, I think it comes back to the earlier point is that we all have a danger of extrapolating growth, and we've had well above trend growth now for the last 18 months. A lot of it's been tax-induced, fiscal programs, extraordinarily relaxed monetary policy, and we're going to have to start to live over the next 12 months with data points coming in undershooting what we would have expected and a much more normal year-on-year trend in profits.
Sean, okay, what you just said before about margins and the like here as well, and all of this does impact industrial profits, if you look at just that, but industrial profits are not just for industrial companies. But that dovetails into nominal GDP, doesn't it? And then nominal GDP itself dovetails into real GDP.
Yeah. So I think we've been extraordinarily fortunate that nominal profit has been so wide versus nominal yields. I mean, you have to go back to the 1950s to see this type of gap in profits, and it's been deliberately generated by the governments. Essentially, every time the United States has fought a war, it's targeted nominal GDP and kept nominal interest rates very low, and they've done exactly that. The difficulty, again, is that if you start to keep real rates so negative that you'll end up with having an asset bubble coming through in the economy, which makes life much more difficult to adjust policy, say, 12 to 24 months down the road.